just remember working with people who were working on the same policy idea for 12 years. And I wanted wins and losses to happen faster. And so I wanted to get closer to innovation within the environmental umbrella. We try and invest in companies that we think could be the only game in town for a really long time in the hardest to decarbonize sectors. The brief history of China with renewables is they've had some very ambitious clean energy goals. And the goal for them was to become the Saudi Arabia of renewables.
Welcome back to Clean Techies, the #1 podcast for climate tech entrepreneurs. I'm Somil.
And I'm Silas. Each week, we publish the secrets to success from investors, founders, operators, and experts in climate tech around the world. Building a startup is hard. Building a climate tech startup is even harder. But we make it a little bit easier.
We put a lot of effort into these shows, so we hope you enjoy. Don't forget to subscribe, leave us a review, and let us know who you think we should have on next.
With that, let's get into today's episode. Hey everyone, quick note for you. You're currently listening to the free preview of this episode. If you'd like the full thing, the full shebang, go over to our Substack. That's cleantechies.substack.com/subscribe and become a paid subscriber. Any paid subscription gets you full access to the show on the Clean Techies Substack.
Today, we get to sit down with Peter Sofer, an investment partner at Clean Energy Ventures. Peter is based in Austin, Texas, and is a board observer of many rockstar companies like Industrial, Bodhi, Connect DER, and Encycle. Being in Texas, he has been at the forefront of climate tech investing in some of the most challenging sectors to decarbonize. With the recent close of Clean Energy Ventures' second fund, Peter talks to us about the firm's fund strategy, seed and Series A investing. Peter opens up about the need for founders to be clear and efficient in hitting milestones, especially as non-dilutive funding may shrink in the coming years. He also discusses the potential challenges and opportunities that lie ahead if there is a shift in the political landscape and how Clean Energy Ventures is navigating those uncertain waters. He teaches us about his thoughts on industrial heat decarb, data center decarb, and his thoughts on the hype cycles surrounding technologies like direct air capture and geothermal technology. His approach to networking, team building, and the fundamentals of venture capital offer valuable lessons for anyone looking to make an impact in the climate tech space. Enjoy this episode. All right, Peter, welcome to the show. How are you?
Things are great. Thanks for having me. I think you all do a great job, and so it's a pleasure to be here.
It's a pleasure to have you. I feel like you're doing some really cool work. Also in a very, very key area, Austin, Texas, right now, especially with some recent news. So I'm going to start off with a favorite question of ours. If you could have dinner with any clean techie or climate OG, who would it be and why?
Ooh. So I think the OG of OG clean techies is posthumous. It's Teddy Roosevelt. He was a force of nature, a moose. I would love to have dinner with that guy. He's done some great things for conservation, as well as obviously a lot of other things. More of the modern version. I mean, who would turn down a dinner with Elon Musk, no matter what you think of him? He's the one who's cracked the code more so than anyone else on how to do really high degree of difficulty companies. And then I respect the research a lot of Michael Liebrecht from BNEF formerly. And I think Gina McCarthy has a great personality and is really sharp.
Love that. You love a couple of dinners. And honest, your Elon shout might not be too far out with some of the recent announcements we're seeing. So maybe that was a bit clued in there. You talked about Teddy Roosevelt and the conservation. I thought that was interesting. Does that have something to do with why you entered climate tech and are in this space to begin with?
I don't know, maybe subconsciously or indirectly, but I mean, I studied environmental science in undergrad, and there were some classes where some of his stuff we studied. But I think I was more drawn to the fact that just the need to mitigate greenhouse gas emissions, and as well as just how engaging a lot of the technology solutions are, and how complex the pieces are to the puzzle fit together.
Totally agreed. And we'd love to take a second just to hear a little bit about your background and where you come from.
Yeah, so I guess I'm born and raised in Washington, D.C. You don't need to go back that far, though. I'm currently at Clean Energy Ventures. I'm an investment partner. Been here for 5 years. We recently closed our second fund, which is a $305 million fund targeting seed and Series A financings, which is a similar strategy, just with larger checks, and an expanded geography to Europe and Israel as our first fund, which was an $110 million fund. We have 27 portfolio companies in total. 20 are from our first fund. And I guess personally, prior to CEV, the majority of my career was at Environmental Defense Fund, which is a global NGO where I built a foundation on the energy transition. And I've had stints at International Energy Agency, cross boundary, and focus on project finance and just VC deal research.
And so is that why you decided to transition into investing at Clean Energy Ventures, or how did that specific opportunity come up for you?
Yeah, so I guess at Environmental Defense Fund, I loved the energy transition. I thought it was so cool how interdisciplinary it was, how worthy the mission was. But I just remember working with people there who were working on the same policy idea for 12 years. And I wanted wins and losses to happen faster. I saw folks in the innovation ecosystem having a lot more impact, frankly, than I was having there. And so I wanted to get closer to innovation within the environmental umbrella. And VC, I feel very lucky to have landed a job in venture capital.
So you're investing at seed and Series A. You put about 20 investments out of your first fund. Are you targeting a similar? You have a lot more capital. So how are you thinking about that? Are you expanding your check size? And to that point, what check size do you normally invest?
Yeah. So with our second fund, we do $2 to $6 million initial checks in seed and Series A financings. We've led 26 out of the 27 investments we've done. So above 95%. We primarily lead or co-lead, which means we set terms. And for the companies that hit their milestones and are performing, we're budgeting about $10 to $20 million per portfolio company. And so I think the big changes relative to our first fund, we targeted about $5 million in total per portfolio company, where the split between initial and follow-on investment was more skewed towards initial investment.
Got it. And in terms of sectors and where you look, I'd love to hear two things. First, what industries and sectors you look at. And second, how you think about investing in hard tech, deep tech, some of the less venture capital friendly asset classes or technologies.
For sure. So I think the thing that's different about us is that we require potential portfolio companies in an optimistic but realistic scenario to have multi-gigaton scale greenhouse gas mitigation potential, which is a very high bar. It's sometimes deflating when there are companies we think will do financially very well that are very clean, that aren't multi-gigaton scale. But that's an intentional number and a financially oriented, not just an impact oriented number, because it's our belief that we're a venture firm. We want to invest in the next generational startups. We want to invest in the next pillars of the next 50 years. And to become that, your odds are increased if you're addressing a generational problem, which we believe climate change is. So we like to back the companies that are going the furthest to addressing the climate problem. But in terms of subsectors we look at, what's beautiful about the energy transition is the diversity of areas that can make a great impact, from the minerals needed for the energy transition to the various types of solutions for decarbonizing industrial heat and taking the grid from having a max capacity for clean energy from 60% to all the way to 100%. And so I guess in a nutshell, we try and invest in companies that we think could be the only game in town for a really long time in the hardest to decarbonize sectors.
Nice. That's a super futuristic, long-term vision-oriented thinking, which is what we need in the climate problem, right? The last question I'd love to ask before we round out, when you look at the companies that you invest in, I'm curious, are there any companies that investments you've made that you'd love to mention sort of at the top of the portfolio, top of mind for you?
Oh man, all of them. But I guess ones that I think could be particularly impactful are the ones that address like the hardest to decarbonize areas of the economy. So industrial heat, especially very, very hot heat, there is currently no alternative to coal and gas burners and boilers. And when I came across electrified thermal, I was amazed by the simplicity of their solution. It's a brick-based solution. All you do is bake bricks the same way you bake bricks today, but add some powder to it. The low cost they can get to and the hotness of the heat they can get to 1800 plus degrees Celsius. I think it's one of the companies in the space that has an uncapped ceiling and both for financially and for impact. Others that I think fit that description are clear flame engines. There are a lot of limitations of the solutions that we know about for transport. So electric hydrogen, when weight and different weather environments and fueling infrastructure come into play. And I think Clear Flame has a great solution, the only one that I know of that can replace diesel economically.
I love that. And who knows, maybe we'll reach out to you to have them on as future guests, right? Maybe that's the pipeline that we're building here.
They'd be amazing, yes.
Yeah. The last question I'd love to ask, of the great founders that you've invested in and the ones that continue to work with, we'd love to hear from you. What are the top 3 things in any order that you think founders can do to impress you, especially the ones you've worked with and even the ones that you've come across in general?
Yeah. So in terms of the way I see the job as the CEO, I think Sam Altman has a great sort of concise way of putting it. Is at least what he does at OpenAI is he's very hands-on in making the initial hires, but then he gives the very capable people who he's hired a lot of autonomy. So I'm extremely impressed when I see founders and CEOs who know how to delegate, know how to be a team member and empower their teammates to maximize the volume that a startup can consume. And I guess hand in hand with that is a strong culture, which is both positive but holds people accountable. And then lastly, just an ability to create a big vision that attracts people to follow it.
That's awesome, man. I really appreciate that. This resonates a lot with what people have said in the past. But let's get into the meat of things now that we understand kind of the fund and what you guys do. This might be a little bit spicy to get us going, but if come November we see a new administration, how do you think, broadly speaking, it's going to affect the climate tech ecosystem, if at all?
Yes, that is a big question. It's very hard to say, to be honest, what a Trump presidency would mean for climate tech innovation. Based on Trump's first term and his obsession with trying to repeal the Affordable Care Act, despite its popularity, he has a track record as a person who seeks to wipe out the legacies of his predecessors, especially the ones that he considers adversaries, of which Biden is obviously one. So I wouldn't be shocked if he attempts to repeal the IRA. The IRA is a law, not an executive order. So like the Affordable Care Act, it'll be very difficult to repeal, especially because it benefits economies in key states. But I remember in 2015, the climate world was supremely confident that the Clean Power Plan would get implemented, only to be supremely disappointed. So anything can happen. I think that grant financing will be significantly less plentiful for climate tech innovations. So the ability to fundraise will become even more important for founders. I think what matters more than the election, though, is the economy, or at least to climate tech. Residential solar is one example where it's a bloodbath right now. It's at a 10-year plus low, and Biden's president. And it's not because of Biden. It's because there are a lot of sectors like that rely on lower interest rate environments for thriving. And yeah, I guess the lower the interest rate is, the higher the return on investment is for a good proportion of the climate tech sectors that require project financing or require people to take out loans for financing. I also think that Trump hangs his hat on making life hard on China. So, given the world's current reliance on China for energy transition metals and core tech like solar panels, I think Trump may want to quietly continue subsidies in these areas. During the first Trump administration, one thing that was really encouraging was the stewardship by corporates. And I think to the interest rate point, I think they need to really feel rich to beat the drum of corporate sustainability like they did during the sort of 2015 to 2020 timeframe. But if the economy is good, I think there is precedent, even if the president is not beating the drum for climate for a lot of other parts of the economy to do so.
Climate tech founders are taking on a huge challenge. Not only do they need to know how to build a startup, but they also need to deal with hardware, have a strong handle on climate policy, know how to fundraise from diverse investor types. It's a lot.
That's why we made Clean Techies, the #1 podcast for climate tech entrepreneurs. In addition to our jobs, we devote 20 hours a week to producing this podcast for you. This way you can learn from the people who have walked the path before you, learn from their mistakes, and gain insights on navigating this complex journey. If this mission resonates with you, we are asking for your help. It takes a lot of effort and it's not free.
If you are already a subscriber and want to help, start supporting us today by going to Substack and clicking Upgrade to Paid. Thanks for helping all the climate tech entrepreneurs like you.
So let's break down. You gave such great insights. The three things you're really mentioning, one, which is, reduced availability of non-dilutive funding. The second is the macroeconomic conditions. We've been in somewhat of like I don't know, this might be overstating it, but a slump, right? Especially as you talk about what are the exit conditions within the market. And then the third is, how we feel about China nearshoring production. I love to start with the first one, the reduced funding and availability of grants. I think especially at the stage you invest in, you're starting to see somewhat of an evolution of how founders think about starting and finding product market fit to how do you then take a more de-risked commercializable technology and go towards those either loan programs or non-dilutive funding meant for things that have already been slightly de-risked. How are you thinking about the companies that you invest now that the investments you make will likely impact some of these, tailwinds or headwinds, depending on what they are? How do you think about the investments that you make and manage those expectations?
So I think that first is we've become, it's always been a priority, but it's going to be even more important than ever that founders know how to raise from VCs and understand the venture mindset and the venture model and understand sort of the story that would resonate with an investor. And so just an ability to fundraise is going to be increasingly important. It'll just force companies to be better across the board, though, be clearer about the milestones that they prioritize and strive towards, and that they're capital efficient, and that the milestones they hit are value add to an external audience.
So broadly speaking, just tightening up the ship and kind of like in continuation of these past couple of years that have been tough for venture in the first place. You're just saying they need to tighten up the ship and make sure they really know what's going to be most impactful to get to that next round, because the availability of non-dilutive capital may be a little bit harder to come by. Would that be a good summary?
I think so. Exactly. I think so it's not a certainty that grant financing will dry up, but I think it's a pretty good assumption to be making, and the money needs to come from somewhere. So I think it'll increase the importance that VCs play in financing sort of earlier stage tech. Yeah.
So let's talk a little bit about the China question. So, this is the part where I don't necessarily have straightforward questions for you, but I want to kind of discuss this as the three of us. Recently, I heard somebody point out that in a lot of ways, Biden actually continued a lot of the China-related policies that Trump had in his first term. So you could say that if the trend is the same, likely he'll just continue doing what he did in the first term, but he probably will just call it something different because he's always about marketing things and just sounding like he's anti-Democrat for his base. So I'm just kind of curious if you have any particular points or things that you want to talk about when it comes to this onshoring of production here to kind of fight the China piece, because I think it's pretty clear he's anti-China, and in a lot of ways Biden has done some similar things with the tariffs recently. So I just want to like start unpacking this a little bit more. I don't know exactly where we should start. So I don't know if you have any places you want to jump in.
I think one of the most relevant things as an investor is where you stand on, do I support onshoring with my investments, or am I looking for the best opportunity? I'd love to hear from you when you look at a technology that may not be as strong right now in terms of unit economics because it's trying to onshore production. Will you still be more friendly towards making that investment? How do you think about that balance?
So I guess the least satisfying answer anyone can give is it depends. So I guess the brief history of China with renewables is ever since their 5-year plans from I think as early as 2005, but even earlier maybe, they've had some very ambitious clean energy goals in their national agenda, and they've executed on it. And the goal for them was to become the Saudi Arabia of renewables. And you look at them now and they have ownership or refining capability for something like 80 plus, 90 plus, 95 plus percent of most of the key energy transition metals. They have by far the cheapest solar panels and technology out there. They've got EVs that blow out of the water on cost the EVs from other parts of the world, and so in terms of whether you want to compete with that or not, it's sector specific and subsector specific, at least I think, because like take solar for an example. Chinese solar panels are cheap, but they're also cheap partly because they benefit from basically dumping, basically like predatory pricing and just underpricing whoever else is going to try. And there is the policy risk in trying to compete with China on solar panels is incredibly high. And whereas I think there are ways you can onshore. And one example is one of our portfolio companies, Nth Cycle, which does battery recycling and mine tailings recycling, where it basically enables batteries that are used in the U.S. to recycle critical minerals like cobalt and nickel and manganese and copper without A, needing China to produce those minerals, or B, requiring transportation to and from China for refining. And so that makes a ton of sense. There's a commodity market that these metals sell into, so they're not subject to Chinese dumping. And so I think I'm going to stop there, but that's kind of my view in a nutshell.
Yeah. I want to pose maybe something we can work along with as an example. So I've come across some investments that you're looking at a genuine cost comparison between 2 companies or 3 companies. One has onshoring production, another one doesn't, right? And so you're trying to think about, okay, not only how will my investment now pan out in terms of their early stage commercialization, but I have to think about how will the unit economics over time factor in, right? Is even if a company's trying to onshore something much more expensively right now, they may have a future where they're looking at something with cost parity. You talked about it differs by sector and subsector, and I think that's an incredibly true point, right? You cannot make a big picture statement on this, but I'm curious, when you're looking at subsectors, are you coming across things that you're feeling are more prone to onshoring and more positive, like more growing more, at least in terms of onshoring capacity? Are you coming across anything like that?
So I think the variables at play that make a technology more amenable to onshoring, one is just how geopolitically important the area is, and energy is one of the primary sort of geopolitically sensitive sectors out there. And the second point is the solution reliant on policy to be economic? So to what extent would onshoring imply a green premium? And then relatedly is, are the big buyers in this space ones that are capable of accepting a green premium? And so I think there are areas like metals like sort of to the nth cycle example, that sell into commodity markets that I think are like sort of fit the profile of what is amenable for onshoring. I think there is an upside case or downside depending on how you look at it, where I guess the geopolitical issues are going to become so much more important than we even realize right now in 4 or 5 years, that there could be a high tide that lifts all boats, at least in the climate tech world, even if it's very scary, whatever ignites that. But I do think that the nexus of the overlap in the Venn diagram for economic parity and geopolitical importance is where you need to look.
You've been a great sport with us with these questions. I just want the audience to know that we didn't do much. We didn't give Peter that much time to prep for this, and these are all very hot topic questions that we don't even have the answers to. So we're going to make your life a little easier and now move on to questions in a slightly different realm. The first thing I'd love to ask is, in venture, you're balancing how much are you investing from an equity perspective versus how much capital are you willing to put in. I think this is an extremely cool question for you, because in doing our research for this, your range of how much you'll invest per check is pretty large. It's 2 to 7. So at any round, you have the potential to take 20% equity or the potential to take 5% equity, right? So where do you land on making sure a startup is well capitalized versus not taking too much equity in the deal? How do you think about that?
So we invest at very, very early stages. If you're leading a seed round or leading a Series A round, usually there are 2, 3, 4 more financings that the company has to go. So if we take too big a chunk from the company, even if we're able to, that's a recipe for disaster, because the eventual Series C or Series D investor will look at the team, their share of the cap table, and see it's really low, because we took a big chunk, and then based on our precedent, the next round took a big chunk, and so on. And then the early stage investors will just be the recipients of refinancing that leaves us, I guess, at or below where we would have been otherwise, and adds a lot of headache in the process. At the same time, we can't take too little of a company either, because of the capital intensity. We need to, for the venture community in climate tech to progress, there need to be successful venture capital funds that return very high multiples, to market beating multiples relative to even other sectors like AI, to LPs, that motivate LPs to want to continue to invest in venture capital funds, which then invest in innovation. And for this life cycle to have oxygen, I think that's just how we evaluate deals. And I think part of whether we do the 2 million version of our check size or the 7 million version of our check size is based on the rounds dynamics. So are we leading like a $20 million Series A round, or are we leading a $5 million Series A round? Because we do like to co-invest with peers that add value, and either whether it's strategic value or they're another very smart financial VC at the table that leverages their insights and resources to support the company going forward. And so I think those are some of the dynamics that go into determining what our check size is, what valuation should be for the startup, and whether we do the 2 million or 7 million version of our initial check.
Just theoretically, there's no money on the table. There's no money in this question right now. So by no means this is binding. But let's say that a company needs a lot of capital, right? Your goal is to make sure that they're well capitalized. In order to do so, you'll have to up your equity stake in the company versus playing the waiting game and waiting for other co-investors to jump in. I'm curious, when you hear that question, Have you had positive experiences getting co-investors around the table, or has it been somewhat of an uphill battle? I'm also curious because what we've heard, especially recently, is that a lot of people are holding their money until we get more visibility into the new political administration and what it's going to be. So based on what you're seeing right now, especially since you're actively investing out of a new fund, are you erring on the side of taking on more responsibility and capitalizing startups, or waiting for other co-investors to come in? Thanks so much for listening this far in. If you're here and want to listen to the rest of the episode, go to cleantechies.substack.com and click upgrade to paid to become a premium Clean Techie. With that, you'll get access to all of our full-length episodes, monthly shows with me and Silas, and access to our premium community, where we offer our support and invite-only events.